Good morning, everyone, and welcome to the Sports Betting M&A webinar. You are in listen-only mode, but you can ask questions by typing them into the box you see on the right side of your screen. I will make a few introductory comments, and then we'll hear from each of our speakers, and then we'll ask follow-up questions taken from your submissions. We are recording this webinar, and you will all receive a link to the recording in a follow-up email in case you want to view it again or pass it along to a colleague to review. My name is Robert Heller, and I'm the CEO of Spectrum Gaming Capital. We are investment bankers and financial advisors working exclusively with the global gaming industry. We're a member of the Spectrum Gaming Sports Group, an association of several organizations with backgrounds in sports betting and other forms of internet and land-based gaming and lottery operations to service the emerging U.S. sports betting market. Today's webinar is part of a series the Spectrum Gaming Sports Group is hosting with GeoComply. GeoComply is the global leader in geolocation compliance technology. Since launching in 2011, GeoComply has quickly become the iGaming industry's trusted solution for reliable, accurate, and compliant geolocation services. They are powering all of the sportsbook platforms that have launched in New Jersey. We have a great panel of speakers today, including some of gaming industry's luminaries, including Matt Davey, head of SG Digital, which includes NYX Gaming, Dennis Elling, the lawyer that represented Paddy Power in its acquisition of FanDuel, Michael Kogan, head of gaming investment banking at Canaccord Genuity, Adam Rosenberg, who runs gaming and leisure globally for the Fortress Funds, and Richard Chung, the CFO of GeoComply. We'll have about 5 minutes of speaking from each of our speakers, and then we'll answer questions at the end. Have a first slide, please. Sports betting, this is a slide that you can find on our website, spectrumgamingcapital.com. It shows here on the first slide that sports betting is moving quickly in the US as compared to iGaming, which continues to move slowly, although we all hope that maybe sports betting's adoption will move iGaming along more quickly. This slide shows the status of legalized sports betting in the US, and as will the next slide. And what we're seeing here is that 5 states currently offer legal sports betting. New Jersey and Delaware began in June, and New Jersey started the first remote version, the digital version that you can do on your phones last month. Mississippi started in August, and West Virginia began just this month with a land-based version. There are about 18 million people in these 5 states, and about 70% of those people are over the age of 21. Through the end of August, there's been about $175 million wagered, about $107 per adult in these states collectively, at about a 5% hold percentage. So it's yielded GGR to the industry of about $20 million. 5 additional states have legalized sports betting, but have not yet finished their regulations, although we do not expect Oregon or Montana to really embrace sports betting now. There are double the number of people in these 5 states, about 40 million. Critically, eyes are on New York to see if they go forward with the first integrity fee to be paid by the leagues. You see that in the league royalty column. Go to the next slide, please. So these states are considering sports legislation. It's been proposed, but they're still in their early stages. But together, they represent another third of the US population. So together with the first group that's already passed legislation, you're talking about half the US population is already contemplating very seriously or have already started sports betting. And with that information, let's introduce our first speaker, Matt Davey. So Matt Davey is
Thanks.
the chief executive of SG Digital, a division of Scientific Games. Matt was formerly CEO of NYX, which he sold to Scientific Games. Among the very many acquisitions Matt made at NYX was OpenBet, which built NYX into a sports betting powerhouse. Matt, we have 3 questions for you this morning. Number 1, can you describe your strategy in building NYX? Number 2, why did you sell to SG, Scientific Games? And 3, do you see more European gaming companies coming here, like did Paddy Power to buy FanDuel?
Appreciate the introduction there. So, yeah, just in terms of the first question, the strategy around building NYX, we started out our life as a content studio called Next Gen Gaming. And we knew that to really gain scale in the industry, we needed to control distribution. So the very first acquisition we executed was the merger with a company called NYX Interactive or Nix Interactive, which had a wonderful platform for the lottery and bingo business, but really lacked a lot of the content that we built out of our content studio. So by combining the two, we now had a very powerful platform to grow. But the other key constraint for us was really size. Our competitors were probably 100, 200 times bigger, both in terms of staff, internal resources, market reach, product reach, etc. So acquiring a few other businesses on the private side, it's really a slow process. And one of the keys for us was really going public. And we have another speaker here, Michael Kogan from Canaccord, who really helped facilitate the go public process, as well as then the capital raising we did over the 3 years or so that we were a public business. During that time, we executed on around 7 or 8 different transactions. All of those were designed to do one of 2 things. One was to increase our product portfolio, or 2, increase our penetration into new markets. So new markets being, for instance, into the UK or into Europe, or in some respects into the US market. So our strategy really was around gaining scale. Our feeling was, from the board perspective, that a business that's in the B2B side of the gaming industry really has a couple of key drivers here. One, operators probably want less suppliers than more. Life is very complex as it stands, and so dealing with a smaller number of suppliers is easier. They then tend to drive for a single integration from which they can get access to the full range of products. And we knew that by doing that, we could A, gain more customers, and B, drive higher margins once we had all those products under the one umbrella. And then why did we sell to Scientific Games? My feeling has been that the land-based manufacturers took their time getting into the digital space. And when I looked at the various assets and profiles of the land-based manufacturers, it was clear that Scientific Games was the most likely buyer of our business. They could generate the best in terms of synergies, as well as leveraging the assets we had versus the assets they had. So in my mind, it was always the clear standout in terms of a combination of assets. And I guess the only thing that surprised us was the speed around which it happened. And part of that was obviously generated on the back of the emerging US sports betting market.
And then as far as what do you see in the future with other European gaming companies possibly coming here and following in your lead similarly?
So when we look around the gaming industry, there are a number of mature markets that are well regulated. The UK probably is the best example of that. There are a number of semi-mature markets that are unregulated, and those are difficult to really map any kind of future value to, simply because you just don't know which way regulations will fall if and when they do come into those less regulated markets. What the US represents is an emerging regulated market with a pretty clear view on what the demand for gaming products looks like. So it represents a highly attractive option for any gaming company looking to grow its business. So I think if you look at the European operators, they're all looking for growth, and the US represents a really key part of that. So I think we have seen the first wave of European operators moving into the market, doing joint ventures, doing licensing deals, signing up and launching their products in some of the states here. I think you'll continue to see that trend over the next couple of years, simply because A, the size of the market, B, the attractiveness once regulations have been propagated.
Well, great. Thank you, Matt. I guess that's good news for Michael and for Adam and myself, for all the parties here, the people who are trying to do deals. Um, let's move on to Dennis, because Dennis represents someone who has helped put together one of the biggest deals, if not the biggest deal in the sports betting space directly. Dennis is a partner in the Los Angeles office of Blank Rome and co-chair of the firm's gaming and entertainment practice. With 20 years of experience, Dennis has been involved in almost every element of gaming, from horse betting to skill games. Critically here, Dennis represented Paddy Power Betfair in its recent acquisition of FanDuel, the first major recent M&A transaction in the sports betting space. Dennis, could you walk us through the deal highlights and describe the logic to both buyer and seller in that transaction? And then at the end, maybe you can tell us or prognosticate, what does this mean for DraftKings, FanDuel's only real competitor in the daily fantasy sports segment in the US?
Sure, Rob. Thanks very much, and good morning to all. Let me preface my comments just by sort of standard lawyer's disclaimer. I am not speaking for either business, and really just offering my own views based on what we experienced as we went through this deal. As Rob indicated, it was a large deal in the industry, the largest at the time, still the largest so far, I think, valued at a little over $1.1 billion. One of the things that that is notable here was the way in which the deal was structured. This deal brought together the U.S. operations of Paddy Power Betfair, which had come into the U.S. Back in 2009 with the acquisition of TVG and TVG's online horse race wagering platform, as well as the TVG television network, and had grown in the 9 years since to include a second TVG2 television network, as well as one of the first and more successful launches of the New Jersey online casino in 2013 and 14, and then the horse racing exchange, the first exchange in the U.S. Through New Jersey that launched in 2015. So all of those U.S. operations were then folded with FanDuel's operations, and FanDuel, which had launched and operated successfully in 41 different states, had the real advantage of a nationwide experience, nationwide relationships, both with legislators and regulators, as well as a nationwide customer base of individuals who had demonstrated their interest in playing games for money related to sports. So it brought both of those. This deal brought both of those together. And a little war story about the deal. We had started in earnest putting the deal together in late April, and after many visits and discussions and visits of board members and the like in the UK, the decision was made that we all needed to come together and just lock ourselves in a room and see if we could get a deal done. And the day we chose to launch those meetings in our offices in New York City turned out to be May 14th. So we're sitting down to do our first in earnest conversations and really drill down on what this deal would be. And we're also all sitting there watching our phones and looking at the SCOTUS blog and becoming, as you can imagine, majorly distracted low around 10 a.m. Everyone stopped what they were doing and tried to read as quickly as they could and see the change that the Supreme Court had wrought to the market, and the amazing amount of a focus that came right after that to make sure this deal got done. I think interestingly, the parties were committed to the deal before the decision of the Supreme Court. Both parties went in expressly saying that they were going to do the deal either way, or at least were committed to trying to do the deal either way. But when they, when the opportunity came to actually expand legal sports betting in the U.S., I think that the impetus was clear. This was a deal that needed to happen, and really to bring together the strengths of both entities. And so let's just talk a little bit about what I think each of the parties saw, the motivations. From the FanDuel side, as I said, they had the nationwide platform. They had a nationwide customer base. What they lacked was real money gaming experience, both from the regulatory standpoint, the compliance standpoint, but also the technology. They were working on building out a real money gaming platform, but building one out versus having one that was tried and tested and they knew would work, those are two different things. And in addition, specific to sports betting, they were looking for and trying to build the know-how and the experience. Sports betting is not like, as probably many folks on this webinar know, sports betting is not like any other casino gaming. You don't turn on a slot machine and wait for people to come and look at your margins. You don't look at you don't turn on set out a table and wait for people to come and just deal cards. There's an awful lot of judgment, skill, pricing, experience that goes into successfully running a sports book, and that's what Paddy Power Betfair brought to the game, having had decades of experience running successful sports books, both in a brick and mortar space as well as online. And that's what FanDuel was looking for, and why it was an attractive deal for them. From Paddy Power's perspective, what they were looking for was really to dramatically scale. They, as I had said, had built a nice business in the U.S., had taken advantage of every legal gaming opportunity that really we could find. But the customer base was limited to the states in which they had horse race wagering, apart from New Jersey. And the customer base were the customers that were primarily focused in the horse racing industry, or at least had enough interest in the horse racing industry to play there regularly. So they were looking for a really nationwide platform as well as a nationwide customer base. I think we talked to the second question that you asked, Rob. What does this sort of prognosticate for DraftKings? Candidly, I think that DraftKings is going to try to. I mean, every indication we've got is that they're trying to go it alone and build sort of organically, but they face a number of challenges. Building a sports book, as we said, building the depth of experience and really capacity to deliver a sports book in each state as it becomes an opportunity to do so, and one of the other challenges related to that is the ability to scale. When in order to successfully operate a sports book, besides all the back-end technology you need, and experience you need, and pricing and risk management, you need to have people who are skilled in it and know how to do it. And in the US, that really means you have to have those people, at least at this point, on the ground, or at least overseeing on the ground in each state. And so scalability is a real issue that I see DraftKings is going to face as they try to build successfully from New Jersey, where they have been operating rather successfully already, into other states as the market opens up. So I think there's an impetus there for them to make a deal where they where they can acquire both that experience and capacity and really depth to be able to scale. And to the to the potential players out there, whether that's other European operators or others that might have the idea of tying up with DraftKings, they can look at again a very broad customer base and a customer base that has shown an interest in sports and has been, I think, from what's been publicly said, converting over to real money betting at a pretty good clip. So, I think they're an attractive tie-up partner. I'd without a whole heck of a lot of direct insight, just what I'm hearing, I wouldn't be surprised to see them do a similar deal sometime in the next 6 months.
Great. Thanks very much, Dennis. That was very helpful. I'm sure we'll have some questions for you later on. Our next speaker is Michael Cogan. Michael is a managing director at Canaccord Genuity, which is Canada's largest independent investment bank, and he leads the Canadian gaming practice there. Michael is a leader in the space, having represented Stars Group, Jackpot Joy, which was called Entertain before, NYX, who we have on the phone, Pollard Banknote, and Sportech. Michael, how do you see the future of sports betting evolving in a corporate sense? Can it be a standalone business, or is it have to be just an element of a more broadly defined digital gaming business? And following on to that, will we be seeing more European companies coming to North America to try to compete with IGT and SG, the two behemoths? Michael?
Sorry, does that work?
Yeah, now we can
Is
hear
that
you,
working?
Mike. Yes.
Oh, sorry, I muted myself and then went to the panel there on the screen. Yeah, I think the best. So first of all, thanks for having me on the panel today. I think the best, example of this would be to look at kind of what's happened in Europe. So if you look at most of the large online operators, if you start with kind of William Hill and Ladbrokes when they were standalone business, and Paddy Power when they were standalone business, and even guys like Betfair, they all started. It was all born out of sports betting, right? First at the retail level, and then onto online with the internet, the growth of the internet. And then what happened was a lot of these businesses, they started offering other gaming products, mostly called casino and table games, and then some of them evolved into bingo as well. So I think in the U.S. market, you'll see something similar to that. So obviously you have a lot of the driving forces there are the European players, and a lot of them offer all the kind of gaming products outside of just sports. So in markets where where only sports will be permitted, I think they'll look at it initially as obviously a standalone business within those markets. But I think they're clearly, like states like New Jersey where they permit other gaming, I suspect their strategy will be similar to the European strategy, where it's offering, all of the different gaming products within one digital wallet in order to capture as much of the consumer's wallet as possible. So I think it'll be really market driven, based on what's allowed and permitted within certain states in the U.S. But where there's a host of products that are available, I suspect they'll try and offer those all up to their consumers. In terms of other European, entrants into the market, the way I see it, I think the Europeans are the ones that are actually leading this. Like if you just look at the stats within New Jersey, on the casino side, they're all of them are the European operators. I'm just looking at it right now. So you have Party there, AAA, Betfair, Resorts through the Stars Group, and I believe NYX had a relationship there as well. So I think a lot of the European ones they're clearly the ones with the most expertise in the field, given their history. I think their brands are also relevant as well. Like if you look at what's going on in Nevada, William Hill is very, uses their brand quite prominently in those operations. If you look how they market themselves, they talk about trust, they talk about the history of gaming, and that's, I think, powerful because ultimately what this is going to be all about brands within these markets. Personally, I've seen some other called smaller operators that are North American based, that are trying to develop their own brands within the space. But I think that the European ones, having the history and the experience and the brand recognition, will be leaders. Sorry, Matt, in terms of scientific games, but that's just my personal view. I mean, obviously, the asset that they acquired was OpenBet within the NYX umbrella, and that was in Europe. And I think they see the strategy as, clearly these are the people with the experience on how to run these businesses, and hence I think they'll have the advantage. And I think we'll see a lot more of that in the U.S. markets. Sorry for being so brief. I don't know if there's any more questions around that, but
no, we will have definitely some questions for you at the end, because some
okay.
come in already. Thank you very much, Michael. Our next speaker is Adam Rosenberg. Adam is a managing director at Fortress Funds, where he is global head of gaming and leisure. Previously, Adam was the global head of gaming for Goldman Sachs. So Adam is used to working on very, very large transactions, and now he's an investor in many of these. Adam, how do you see the future of sports betting evolving in a corporate sense? Who will be the winners and losers? And how do you see the opportunity for financial investors such as yourselves, such as Fortress, typically known for doing riskier deals, more advanced, earlier stage in concept transactions, where it costs more to have you guys on board, but where your involvement helps improve the future outlook for such organizations?
Thanks, Rob, and hello, everybody. Well, I guess I'll start by picking up on a point you made, which is the movement from my role as a banker, which is to serve as advisor and provide access to capital, to a role where I am actually responsible for putting capital to work, and not just putting the capital to work, but managing that investment through the closing and through the execution and ultimate monetization. And so while the toolkit is very similar, the perspective is pretty different. And I'll start as a pivot by talking about regulation and regulators, because I think it's a good place to frame some answers to your questions. So regulators kind of start where they are. They tend not to be very innovative and forward thinking. And so when I think about where this is going and how I see sports betting evolving in a corporate sense, which is the question you asked me, I think it will lead to a couple of conclusions, some of which may seem obvious, but some of which might not seem so obvious. So the obvious ones, I think, might be it will be land-based first, because many jurisdictions already have land-based gambling in some form, casinos or racing or others, and regulators are more comfortable starting with something that they kind of know, and move from there. Ultimately, the growth of the sports betting business in the country will depend upon going mobile, as everything does. And we're starting to see that happen, as you mentioned, Rob, with some of the legislation state by state, beginning on the land, but ultimately recognizing the need to get on the web. So when you then think about who are the winners and losers in that, this is where the obvious and not so obvious may come into play. So the regional casino owners are obvious beneficiaries of this, some of whom already have Las Vegas sports books and others do not. So you're starting to see this forced speed dating between lots of regional operators and various providers of technology, whether they're land-based sportsbook or online sportsbook or combinations of the two, in a flurry of activity, which is really exciting and really interesting. And the other obvious group of beneficiaries are the tech companies that provide various parts of the food chain of translating a wager into an ultimate outcome. And there are companies that control multiple and even all aspects of that food chain, and there are companies that focus on specific parts of it. And so we are seeing some of the obvious companies, as others on the call have mentioned, Games, IGT, the former fantasy sports companies, FanDuel and DraftKings, et cetera. But we're also seeing companies that might not be as familiar to the typical, certainly U.S. investors in the gaming space, like Kambi, who's partnered with Rush Street and is a part of the DraftKings solution, or Bet365, which is partnered at Hard Rock Atlantic City, or SB Tech, which has deals with the Golden Nugget properties and Churchill, et cetera. So there's this little mini convergence happening that's maybe analogous to what we saw 5 years ago or so, when all of the big slot and lottery and then ultimately some internet gaming companies all got smashed together in a whole bunch of M&A deals. We're starting to see some of that on a smaller scale. So those may be more obvious. I'd say what may not be so obvious is what I would also think of as a, quote, winner in all this is young people. And there's a lot of debate in our industry, much of which is run by people from other generations who really struggle with what's happening in specifically the land-based casino environment. And they've got these massive, expensive fixed assets that are clearly going through demographic change. Their customers are aging. Young people spend time in these buildings, but tend not to engage with the content in the same way that their parents and grandparents did. And so the idea of giving young people more things to do, and I hate using the term millennials because I think it's more about 25 to 45-year-olds who do have disposable income and do spend, but they're not playing slot machines, certainly not to the same extent as previous generations did. So the introduction of Sportsbook, I think, is a tremendous amenity, offering, incentive to get and keep young people on site. And the way young people will then continue to benefit is now that they have more reasons to come and to stay, the properties, of course, benefit in all kinds of ancillary ways. So while the sportsbook makes some money, I think most property owners and operators would tell you the real benefit of the sportsbook is around events when people come and they make a sports bet, but then they have an extra meal, they stay an extra night, they gamble, they shop, and et cetera on property. And that will then lead to and feed this broader rethink that the industry is going through as to what the casino of the future will be. And I don't just mean the casino floor, I mean the whole organized experience that we're presenting to people who are getting younger in terms of the customer base. I'm reminded of a conversation I had recently with somebody about how young people see the world and consume and experience things, and it's different from the way certainly I do. So I'm 50, I have 3 teenagers. My youngest son will walk around the house holding his laptop with one hand, with his headphones in. He'll sit down and eat with one hand while he's typing on his keyboard with the other hand. And that seems like a mess to me, but he's able to make sense of that. And I think we have to start to realize that to cater to his generation, and I realize he's not the target demographic, at least not yet, we have to rethink this idea that the casino is here, the nightclubs are there, the restaurants are upstairs, the bar is on the corner. I think in the future, we'll start to see a lot of these experiences all get mixed together, and we're going to have to rethink it that way to make it work. And I think Sportsbook is going to be a big part of that. So in terms of the opportunity for financial investors, so there are established companies, and we've talked about them, and there are the newcomers. For early stage investing, Rob, I guess I would differ a little bit with how you describe the kinds of things I and others who are managing money and putting capital to work think about the world. It's really, really hard to do early stage tech investing or VC style investing in the regulated gambling industry, because you have these thresholds that if you're willing to go through them, you must be willing to be licensed. And that means not just you personally who happen to be directing the fund, but your whole organization. And in some jurisdictions and for some organizations, that's just a very challenging thing to do. And there are structural solutions, and we've created some of them and implemented some of them to have real exposure to some of these companies, including upside exposure, without tripping through regulatory or licensing burdens. But you have to be very careful in how you do it. I'd say the last point I'd make on how we think about what's interesting as the world evolves and sports betting, land-based and mobile, becomes more interesting is which businesses are providing commoditized product and which businesses are more core and central to where all this is going. You know, for example, I love to focus on what I call gatekeeper businesses. So no matter who wins or loses, for example, in the fight over putting a new casino in Massachusetts, the slot suppliers win, all of them, because no matter which operator gets an opportunity, they will have a certain percentage of their floor that goes to, you know, fill in the blank, Aristocrat, IGT, Cygames, et cetera. So I like to try and put that lens on this business as well. Without shamelessly plugging GeoComply, because they're on the panel, I think it's a great example, which is there's lots of different parts of the technological solution that various operators will implement as they turn on their sports book on land and on mobile. But unless they have sufficient and regulatory approved abilities to geolocate and satisfy the standards of the jurisdiction, it's not gonna work. And so, you know, companies like GeoComply, and there are others who will necessarily be part of the solution no matter which direction it takes, I think are really interesting companies to keep an eye on. So
Very
I'll
well
pause
said.
there. Of course, I'm happy to answer any questions further on.
We will come back to you. Thank you very much for that, Adam. Our last speaker is right from GeoComply, who is our co-host here, and that is Richard Chung, who is the CFO. Prior to joining GeoComply, Richard worked with many technology companies and has been involved in over a dozen M&A deals, including 2 public company exits. Most recently, he was CFO for TIO Networks, which was sold to PayPal for about $300 million. Richard, your company provides essential technology for the iGaming and sports betting business, and you've seen lots of M&A activity. You just got a good send up from Fortress Funds. Do you see firms like yourselves one day being part of a bigger enterprise that becomes a one-stop shop for the multiple technologies in the gaming space? And a follow-up question to that, with most of the big gaming companies having already established partnerships with sports betting providers, is there still opportunity for digital gaming technology companies to enter the U.S. market?
Hi, Robert. Thank you very much for the question. So absolutely to the first question. Although I am new to the gaming space, I feel to some degree I've seen some of these same characteristics before in the fintech space, except everything is happening so much faster. Fintech grew steadily from the original dot-com boom nearly 20 years ago. In our case, the whole market for online sports betting has been prohibited. So with the repeal of PASPA, we're getting 2 decades worth of growth within an accelerated timeline. This represents unique business and investment opportunities. In terms of how we can capitalize on that growth, there is no question that with increase in addressable market post-PASPA, we can take the opportunity to increase our product portfolio and create more of that one-stop shop. As Robert mentioned in the intro, GeoComply currently supports regulated online casino, poker, sports betting, lottery, and daily fantasy sports operators in 42 states. to ensure compliance with state and federal regulations. We focus on the critical and important requirement to validate that the user is indeed within the allowed borders permitted for play. Currently, we are already integrated into every live platform operating in these regulated markets for these products, with a near 100% market share of the regulated US iGaming market. From our side, we would prefer to grow organically, or perhaps through selective acquisition of other firms. But there's no question that we have received significant inbound inquiries from private equity firms, operators, platform providers, and sports franchise owners, all interested in how they can expand their product range or exposure to the space. We are in many ways both the hunter and the hunted right now. With so much growth just around the corner, unless an amazing offer comes along, we will continue to scale the business. And when the timing is right, perhaps take the company public. A public offering would provide liquidity to our current shareholders and would also allow institutional and retail investors to participate in our continued growth. And to your second question, but whether or not there's an opportunity for digital gaming technology companies to enter the US market, well, I think the answer to this is yes. We've seen many partnership deals, and Adam had mentioned a couple of SP Tech partnering with Golden Nugget, Churchill Downs, Resorts Casino. GBC Holdings has partnered with MGM and Boyd. Canby has collaborated with both Sugar House and DraftKings. Although there are quite a few well-established digital platform providers in the US, such as Scientific Games and IGT, there will be room for more operators to forge additional partnerships as sports betting continues to roll out to various states. We're at the very early stages of the market. I think there's plenty of scope for entrants who have something to offer to enter later in the game. Entrants with an operator-friendly or user-friendly platform will do really well. The focus will be on advanced and innovative platforms that offer players with the state-of-the-art sports betting, in-game betting opportunities, parlay bets, and ease of funding their accounts. But one of the barriers to entry for a new entrant who may not be aware of this is related to state compliance, and Adam touched on that briefly. The onboarding process is very rigorous and spans shareholders, executive officers, and key members of the entrant's business. This group must be prepared to divulge a significant amount of personal data, which includes their employment history, their net worth, tax returns, credit history, criminal and other background checks, and top it all off, fingerprinting. Having gone through the money transmission license requirements with my last fintech venture, I was quite surprised that anyone can top the requests of New York's Department of Financial Services. New York has a reputation of being one of the toughest states to secure an MTL license in financial services. So hats off to the gaming regulators for being that much more thorough in their due diligence process. That said, we look forward to working with new entrants in the marketplace, provided they can actually get through licensing.
Richard, thank you. That was very, very good, very comprehensive. Now we have time just for a few questions, and we're going to go to one from the audience. This question is about the topic that both Adam and Richard addressed, which is this licensing matter, and it ties also into the tax rate. The question is the biggest challenge for it suggests that the biggest challenge for the expansion of online sports betting in the US is overly onerous compliance regulations and greedy tax rates. If that is the case, this questioner wants to know, does that simply serve to create a mass market customer base for the offshore? So in other words, if the goal of sports betting legislation is to bring sports betting into the regulated market and tax it, are they creating too many hurdles to make it difficult for people to get licensed? And are the tax rates too high? Maybe we'll turn to Matt at Cygames, who has the broadest exposure, I would say, overall in the industry right now. Cygames, that is. So what are your thoughts on this question?
Thanks, Rob. Look, I think the question's not, will we create a mass market that stays in the unregulated market? That market exists today. The real question is how much of that offshore consumed sports betting appetite gets brought back here into the US under the regulated framework that the states are putting forward. And that really comes down to the health of the ecosystem. there is an opportunity here for states to change a whole number of levers. They have tax rates, they have the ability to distinguish between retail outlets and mobile outlets. What types of bets can be allowed? Can you have parlays? Are we allowed to have a full range of betting options? In-play betting, for instance, that was recently banned back in Australia, and that's had a negative impact, obviously, in the overall attractiveness of the sports betting product. So we think the right way to look at this is that all 50 states have an opportunity to grow sports betting in that state. Some will have very proactive and progressive regulations, and others will have less so. And we need to look at the overall market as a balance right across all of those states and see just how, on net, the product is regulated and allowed to flourish. That ecosystem is not really just around tax rates. It's around how difficult it is for operators to come into the market. So, for instance, in some states, you have to pay $10 million just to get a license to operate. What kind of payment providers are allowed? What kind of geolocation technology can you use? What kind of gaming products? So, for instance, are you able to provide both sports betting as well as slot products and tablet products, etc.? So there are a range of variables that feed into creating a healthy ecosystem. We think a well-regulated market that provides integrity of data, protection to players, reputable and reliable operators, with an ability for those operators to reinvest in their product and their services, we think that creates a healthy, safe environment for all consumers. And we think that's a good thing for US states to proactively create, because the alternative is not that people don't gamble. The alternative is they just gamble in less regulated and less safe environments. So the way to really think about this question is, on balance, how do the states roll that out? And we think that there will be both ends of the spectrum represented in the US, but obviously our interest is in helping regulators establish a healthy ecosystem that protects all stakeholders in this business.
Thank you, Matt. Next question is directed to Dennis. It's about the FanDuel transaction. FanDuel was, at least most people perceived, a company that had generated a lot of customer action, a good amount of revenues, but not a lot of profit because it was still in its development stage. But this was a large transaction. How did you go about coming up with a valuation and pricing in this sort of a transaction, Dennis?
That's a really great question, and I have to say that you can, obviously, in any time you do a transaction, you can look to lots of different variables, different metrics to try and put a price on it. I think in this situation, where I will tell you that both Paddy Power, Betfair, and FanDuel actually came to a pretty remarkably consistent understanding of the best way to value it, and it was to look at the revenue that was being generated as well as the customer base, the breadth of that revenue. When you looked at both of those, you then, from a perhaps an investment side or a more established business side, you could look and say, okay, how are those two metrics going to translate into the potential for profitability and a potential profitability, in a relatively short term. And so putting those two together, they were able to come up with a valuation. I don't think that valuation's been discussed publicly, so I'm not sure I'm at liberty to say, but it certainly was a very significant valuation, driven primarily on the basis of the revenue growth and consistency, and how that translated across the existing customer base and the breadth of the customer base.
Got it. So I guess what we're saying is that they took the metrics that drove them to the deal. They put some estimates on that over the next few years, and that was a cash flow that they put a multiple on.
Exactly.
Got it. Thank you. Next question. It levers off a question, a comment that was made by Richard. And I'm going to direct this question to Michael. We've seen, as Adam pointed out, we've seen so many companies make deals already, joint ventures and the like, or strategic commercial relationships, shall we say, with the European gaming companies and the US operators. The question one might ask is, if another European technology company, and there are so many of them, want to come to the States and do something big and substantial, is it too late now? Have all the deals been made already? Or has everyone tied up, or are these short-term type of relationships and there's always room for the future? Michael. Michael still may be on mute.
Thank you. Yeah, thank you. That's a great question. I don't think it's too late. I think in terms of displacing your existing, call it platform provider or supplier, as it relates to technology, that's quite difficult. And I think Matt Davey could attest to that. You know, once you have a sportsbook partner, it's difficult. You often don't want to change, because why would you change? Things are working out. And when you do change, there's risks around migration, losing players, disruption of business, and so on. So that's quite difficult. So in terms of kind of new entrants, and I've had discussions with a few, there's an opportunity there. Some of them are European, some of them are actually US based. I don't think it's too late. A lot of you described the larger ones. I think, you know, some of the larger ones that aren't in the US market now, some of it could be for regulatory reasons. They may have supplied, you know, operators and call it gray or dark markets. So a lot of the larger, you know, established platform providers that have had a good record historically with dealing with white markets as opposed to kind of darker markets, they seem to already be there. But I think there's still opportunities for, you know, smaller platform providers with new operators that are entering the market.
So it's what you're saying though is it's more on the small side because it's too hard for the big guys to switch off to a new platform.
No, I think the question was, are there opportunities for platform providers that aren't currently in the market to offer their services to some of the operators, right? And whether they can displace an existing platform provider to some operator.
Right.
Like, for example, OpenBet within Scientific Games, if they're servicing, you know, Sky Bet or whoever it might be, would it be easy for a different platform provider to displace them? I think that'd be quite difficult. But I do think that some of the platform providers will have that don't have an existing relationship with an operator that doesn't have a platform. I think there's certainly opportunities for them, whether they're, call it an operator with a lot of history, or someone that's new to the market.
Got it. Good, thank you. Next question, and it'll be the second to last, goes to Adam, and it's another big picture question. We've seen really the deals all being B2B providers coming in and making deals to provide platforms and for the US operators. What about on the B2C side? Is there someone who is both B2B and B2C in Europe, for example? What's the likelihood that they come in and say, "Hey, I'm going to buy a U.S. gaming company"?
Well, I'll start this off, and maybe others on the call may have more specific knowledge of European companies to answer that part of your question. But I think it's a challenge for the established players. And I'll use IGT and Cy Games as examples. You know, IGT at their investor day, despite their best efforts to tell the story they wanted to tell, you know, their investor day happened to be at the time when there was a lot of publicity around what was going on with sports betting around the country, and they kept getting forced to talk more and more about their sports betting strategy, which is still in formation. But they were very careful to say that they are a B2B player to their customers, and they intend to continue to be a B2B player. And that's a strategic decision that they've made, at least for the moment, to not compete with their.
This question is more about, I may have misspoke. This question is more about the B2C players, the people who.
Yeah. No, I'll get to that. So I think Cygames is probably more of a mix, and Matt could speak to this more specifically than I can in terms of being B2C. But the challenge of the B2C platform is the regulatory one, and we keep coming back to it, which is if you really are going to be interfacing with customers, you now have to enter the world of geolocation, KYC, doing all kinds of things that some of these companies might not be set up to do if they are really used to being in the business of providing online venues for gambling directly by customers in jurisdictions that are less regulated, shall we say, or differently regulated, like in Europe. So will we see more of it? Of course we will. And as the states roll out and this becomes more of an attractive platform on this side of the ocean, we'll see more players trying to create a 2C product. But I think others on the panel are probably better placed to talk more specifically about that than I am.
Would anyone else like to comment? Because that's our last, unfortunately, we're almost out of time. Would any of the other people on the panel like to add to what Adam just said?
Yeah, Rob, I think it's Matt here. I think the key framework here to understand is it's not binary. It's not an operator uses a B2B supplier for everything, or an operator uses their own in-house technology for everything. What we've seen develop in the digital gaming industry is this world of co-opetition where operators use a mixture of in-house technology coupled with great third-party technology. And that's certainly the experience we have within Scientific Games. We provide a full stack for an operator to do everything they need using our technology out the gate, all in one box, or they can come to us with an existing tech stack and we'll work within that tech stack as well, be it the provision of slot product, table games, sports betting product, payment processing, etc. So it's not binary. And I think what people really need to focus on here is where do you get leverage for your assets? And that's what operators are thinking about right now. So right now, in my mind, it is incredible to see the number of deals that have happened, given that people still don't know the full size of the market. This is a little bit of a put your finger in the air and think, potentially the market could be worth 150 billion in turnover, $7 to $10 billion in revenue over the next, 10 years. But we don't know exactly how the states will roll out. We still don't know tax rates in most of the states. We haven't seen regulation put forward in most of the states. So everybody's still kind of guessing as to what the long-term value of the market would be. And there are some early movers, you'll see some middle of the pack movers, and you'll see some back of the pack movers. And they will use a combination of their own technology, as well as leveraging the great technology from B2B suppliers like IGT and Scientific Games and others. So it's very much early days now. And I think we'll continue to see new deals come forward. But the market needs to develop before people can put real capital to work and know that they'll get a certain return on the back of that.
Excellent point. Well, I think we're out of time here, and I want to thank all of our panelists for this excellent discussion. We look forward to staying in touch, and to those of you on the web, thank you for attending. Remember, you will receive an email about a replay. Have a good day, all.
Thanks very much. Bye-bye.
Thank you.
Thank you.